Understanding the implied volatility rank metric. Implied volatility, or IV, represents the expected volatility of an underlying asset, such as stocks or futures. Implied volatility is directly influenced by the market's expectation of the underlying asset's degree of movement. In a bull market, volatility gets crushed. There's a lack of fear. The crowd is comfortable, and there's little uncertainty. Implied volatility is one of the major factors that influences the price of an option. While this IV value is useful, it lacks context which would make it more meaningful. Out of this need, a new metric was calculated called Implied Volatility Rank, or simply IV rank. Keep watching to learn more, but first, please take a moment to like our video and subscribe to our channel. IV rank was developed to gauge which stocks, or underlying securities, have opportunity to buy or sell premium at that moment. The IV rank metric is looking at the range where a stock's implied volatility, IV, has been over the last year. 52 weeks is the default, but other timeframes can be used. It shows where in a stock's range it is currently trading in respect to itself. IV rank is interrupted as how big the expected move is of a stock relative to the past year. The higher the IV rank, the more inflated the option prices are relative to the past year. Simple implied volatility tells you the raw price level of a stock, whereas IV rank tells you the relative price level. This puts context around an IV number so you have a reference. IV tells you little about potential buying or selling opportunity. The higher the IV rank, the further away from the money, that is, the current price of the stock, you can go and still receive a good premium. Generally, an IV rank above 30% is considered high. A higher IV rank means an option seller will have a chance at making a better profit, but not that there is a better chance of success. IV rank doesn't tell you direction, just whether you want to be an option buyer or option seller. When IV rank is low, you want to be an option buyer. When IV rank is high, you want to be an option seller. On average, an IV rank higher than 30% suggests that implied volatility may decline throughout a 45-day trade, which is profitable for option sellers. An IV rank lower than 30% suggests the stock may see an increase in its IV over 45 days, unprofitable for option sellers, but profitable for option buyers. Generally, place short premium trades in stocks with an IV rank over 30%, because on average, the next 45 days result in a net decrease in IV, pushing option prices lower. Option contracts are often set with about 45 days until expiration. IV rank is not the same as IV percentile, which uses a different calculation. The trading platforms of TD Ameritrade's Think or Swim and Tastytrade's Tastywork show IV ranks. Option sellers enjoy several key benefits from trading stocks that have IV ranks above 30%. First, stocks with a high IV rank have a significantly wider break-even point. Secondly, stocks with a high IV rank allow placing strike prices further away from the money, while still receiving a good premium. Finally, stocks with a high IV rank have a higher average profit. High IV rank stocks are good candidates for short iron condor and butterfly option trading strategies.